What if I told you that waiting just 10 years to start optimizing your investments is going to cost you over $400,000?
Yeah, that is a wild number.
Right, and that's even if you end up investing the exact same amount of money out of your own pocket.
Oh, exactly.
Yeah.
It's the classic trap.
It really is. When people first decide they want to get serious about their portfolio, there is this almost like universal impulse to jump straight to the sexy stuff.
Right, the fun part.
Exactly. They want to fire up a brokerage app, hunt down the next big tech disruptor, and just watch the lines go green.
I mean, we all do. It's human nature.
Yeah, but the more I looked at our sources for today, the more I realized that jumping straight into stock picking is basically like trying to build a custom slate roof before you've even bothered to pour the concrete foundation for the house.
That is a perfect way to look at it, honestly.
Like, it might look impressive to your neighbors for a minute, but the second a storm rolls in, the entire structure is coming down.
Yeah, because the foundation dictates the limits of the structure,
Right.
You're building a financial framework meant to last decades. But if you do it on top of mud, it is a recipe for absolute disaster.
100%.
Yet, I mean, we see millions of people approach their wealth management exactly this way every single day.
Mm.
They focus on the complex maneuvers while just completely ignoring the structural integrity of their overall financial picture.
Okay, let's unpack this, because today our mission on this deep dive is to cut through all that noise.
Yeah, absolutely.
We are skipping past the flashy headlines and the day trading volatility to look at a comprehensive, a single guide on 7 tried and true investment principles.
Right, getting back to basics.
And for you listening, whether you're prepping to open your first account or just making sure your current portfolio is on track, we know you already understand the basics.
Yeah, you know what a 401k is.
Exactly. You know what an index fund is? Today is about taking that knowledge and optimizing it without drowning in a wall of financial jargon.
I love that.
This deep dive is custom tailored to give you those key aha moments to actually drive long-term success. We are basically looking at the universal laws of gravity for your money.
Framing this around gravity is incredibly appropriate. The reality of wealth building is that it's not a chaotic, get-rich-quick sprint.
No, not at all.
It's calm, it's analytical, and it's heavily reliant on minimizing unforced errors.
Right.
Now, obviously, investment advice requires nuance depending on your individual tax situation and goals, but the core principles we are synthesizing today apply universally.
Because they're just math.
Exactly. They deal with mathematical realities, not market speculation.
So let's talk about those mathematical realities, and let's go back to that concrete foundation.
Let's do it.
Because before we even look at tweaking asset allocation in the market, the source argues we actually have to look outside the stock market entirely. We have to talk about cash reserves and debt. And I want to dig into the nuance here. We all know the classic advice, right? Keep an emergency fund of 3 to 6 months of living expenses in a high-yield savings account.
The standard advice. Yeah.
Right. But for an aggressive investor, holding cash feels like a drag on your portfolio. Why is this cash moat so critical before touching equities?
Well, holding cash might feel like a drag during a bull market, sure. But the underlying mechanic here is about preventing what we call sequence of returns risk.
Okay, break that down for me.
Yeah, so your cash moat protects your equities from the unpredictability of daily life. If a sudden macroeconomic shock hits, say, a massive tech industry layoff, and it happens to coincide with a 20% market correction.
It happens, yeah.
Right, it happens, and suddenly you're without income. If you don't have a cash cushion earning a stable yield, you're forced to liquidate your investments at the absolute bottom of the market just to pay your mortgage.
Oh, wow. So you lock in the loss.
Exactly. You permanently lock in those losses, and you completely destroy the compounding potential of those shares.
Because life happens, The water heater explodes or the car transmission drops out.
Always at the worst time.
Right. And if you have the cash, it's just an inconvenience. If you don't, it's a catastrophic blow to your retirement timeline.
Exactly.
Yeah.
A well-funded high-yield savings account essentially buys you the psychological and financial permission to just leave your long-term investments alone when the market inevitably panics.
It's an insurance policy.
That's exactly what it is. An insurance policy against your own life circumstances. And, well, the second part of that foundation is the friction of debt. High-interest credit card debt, specifically.
Okay, wait. I have to push back on the math here just to make sure I'm getting the severity of this.
Sure.
Because we see credit card interest rates currently hovering well over 20%.
Easily.
Right. Meanwhile, if historical stock market returns are an average of roughly 10% a year.
Right. around 10%.
So if my credit card charges over 20%, but I'm allocating capital into the market hoping to make 10%, investing while carrying that consumer debt is basically like walking up a down escalator, right?
Okay, absolutely.
You're losing money even when you're making it.
The escalator is moving twice as fast as you are. What's fascinating here is how we can reframe debt payoff using the exact same metrics we use for investing.
Oh, I like that. How so?
Well, paying off a credit card that charges 25% interest is a guaranteed risk-free 25% return on your capital.
Wow. Yeah, when you put it like that.
You will not find a guaranteed 25% yield anywhere in the global equities market, period.
Not legally, anyway.
Right. The most sophisticated hedge funds in the world cannot guarantee that return. So any gains you scrape together in your portfolio are being completely devoured by a compounding interest on that card.
Which brings up the actual mechanics of putting that fire out.
Yeah.
We usually hear about two main strategies, right? The avalanche method and the snowball method.
Right.
Now, the avalanche method attacks the highest interest rates first, which makes perfect mathematical sense. But the snowball method, where you pay off the smallest balances first regardless of the interest rate, that's purely a behavioral play, isn't it?
It is. The snowball method acknowledges that, well, human beings are not spreadsheets.
Unfortunately.
Right. Mathematically, the avalanche method saves you the most money. But behaviorally, people need early victories to sustain difficult habits.
Yeah, dopamine hit.
Exactly. Wiping out a small balance entirely provides a dopamine hit. It creates psychological momentum. Depending on your personal wiring, optimizing for behavior can sometimes be more effective than optimizing for pure mathematics.
Yeah, you have to put the fire out before you plant the garden.
Precisely.
So let's say the fire's out. The foundation is poured. Now we can start building the runway.
Yes.
And I want to go back to that mind-blowing number I dropped right at the top of the show, because starting early time is essentially the airplane runway for your investments. Let's look at the actual math from the source about two investors, Sarah and John.
Yeah, the mechanics of compound interest dictate everything here. Let's break down the scenario.
Okay.
So, Sarah starts investing at age 25. She allocates $250 a month, captures an 8% annualized return, and she retires at 65.
Pretty standard.
Right. Assuming no taxes or inflation just to isolate the compounding curve, Sarah retires with $777,169.
Here's where it gets really interesting.
Yeah.
Because then we have John. John decides he has plenty of time, so he waits. He starts investing at age 35, just 10 years later.
Right.
He invests the exact same amount, $250 a month, and achieves the exact same 8% return. When John hits 65, he only has $339,849.
It's a huge difference.
Just by starting a decade earlier, Sarah ends up with over $400,000 more than John. She has more than double the wealth, doing the exact same amount of heavy lifting.
It's incredible. And when you map that out mathematically, you see the true nature of exponential growth. Compound interest isn't just your principal generating a return.
Right.
It's the returns on your returns generating even more returns.
Like a snowball rolling down a hill.
Exactly. The curve is relatively flat for the first decade or two, but at the tail end of the timeline, it goes almost completely vertical. By waiting 10 years, John didn't just miss out on 10 years of his own contributions. He missed out on the most explosive decades of compounding at the very end of his runway.
That is wild, and it perfectly illustrates why defining a specific time horizon is so crucial, you know?
Yes, absolutely.
Moving away from vague ideas like, I want to be wealthy, to setting a goal like, I need $800,000 by age 67. Because once you know how long your runway is, you can calculate the exact velocity you need today.
Your time horizon fundamentally dictates your risk tolerance. A 40-year runway means you can aggressively absorb market volatility because you have decades to recover.
Right, a market crash doesn't matter if you're 25.
Exactly. But a 5-year runway, that means you must prioritize capital preservation. And sticking to velocity, we really have to address the most efficient accelerant available, which is capturing the employer 401k match.
Oh, the ultimate arbitrage. Free money.
Free money, exactly.
We all know what a 401k match is, but I don't think people fully internalize the ROI implications of it.
You really don't.
Like, if an employer matches 100% of your contributions, up to 3% of your salary, and then maybe 50% for the next 2%, failing to capture that is literally rejecting a part of your own compensation package.
It is an immediate, guaranteed 100% return on investment the very second your capital clears the account.
That's insane when you think about it.
It really is. Before the market even opens, your money has doubled.
Yeah.
You cannot optimize a portfolio if you are leaving a guaranteed 100% yield on the table.
Right. And if a traditional 401k isn't available.
Then, optimizing a Roth or traditional IRA provides incredible tax advantages. And if you don't want to manage it, target date funds, like one targeting the year 2060. They'll automatically shift your assets from stocks to bonds as retirement years.
Okay, so we know we need a long runway, and we know we need to utilize the rate tax-advantaged vehicles. But let's look at the engine itself.
Right.
What are we actually buying on this runway? Our source points heavily toward index funds and ETFs tracking major benchmarks like the S&P 500.
Right, broad market exposure.
Right. But let me challenge this for a second with a very common objection I hear all the time.
Go for it.
If an index fund blindly buys the 500 biggest companies in America, aren't you forced to buy the terrible, failing companies too?
Uh-huh.
Doesn't paying an active mutual fund manager protect you from the losers and capture the winners? I mean, buying a cheap fund sounds almost boring.
Well, being boring is entirely the point. Yeah, I mean, it sounds incredibly intuitive to pay an expert to prune the dead weight from your portfolio. But the structural reality of market capitalization weighting proves otherwise.
Okay, how so?
Yes, in a broad index, you will inevitably hold companies that go bankrupt. But here is the asymmetric nature of investing.
Right.
A failing stock can only drop 100%.
Right, it hits zero and stops.
Exactly. It hits zero and it is removed from the index. But a winning stock, that can compound by 1,000%, 5,000% or more.
Oh, wow.
So a handful of massive winners mathematically pull the entire index upward, completely absorbing the drag of those losers. Even Warren Buffett uses index funds, you know.
So capitalism naturally prunes the index for you. The winners rise to the top and become a larger percentage of the fund, and the losers shrink until they disappear.
Precisely.
But why do professional active managers fail to beat this simple strategy over a 20-year timeline? These are Wall Street whizzes with supercomputers.
They fail primarily because of expense ratios.
The fees.
Exactly. When you evaluate an index fund or ETF, you have to look at the internal management fee. Broad index funds run entirely on algorithms. Vanguard's S&P 500 ETF, ticker symbol VOO, operates with an expense ratio of just 0.03%.
That's practically nothing.
It is. That is just $3 a year for every $10,000 invested. An actively managed fund, meanwhile, often charges 1% or more just to cover the salaries of those analysts and their overhead.
Okay, and hear me out, a fee of 1% for a professional manager versus 0.03% for a passive index fund. Honestly, to a lot of people, a 1% fee still sounds incredibly tiny.
I get that. A 1% fee sounds trivial until you apply it to the compound interest curve we discussed with Sarah and John.
Oh, no.
Yeah, that 1% fee isn't just a one-time charge of your initial deposit. It is 1% of your total accumulating balance, siphoned off every single year, regardless of whether the market is up or down.
So it compounds, too.
Exactly. Over a 30 or 40-year investing timeline, that quote-unquote tiny 1% fee will silently devour 20 to 25% of your total potential portfolio value over a lifetime.
Wait, really? A quarter of your wealth?
Yes.
Yeah.
You are surrendering hundreds of thousands of dollars for the privilege of likely underperforming the benchmark.
Wow. Okay, so low-cost index funds completely remove that compounding fee drag. The mathematical blueprint is solved.
Yes, it is.
Foundation poured, runway built, cheap engine installed. But now we hit the absolute hardest part of wealth building, right? Because we have to stop human nature from walking in and taking a sledgehammer to the entire plan.
Oh, man. The behavioral economics of investing is where the vast majority of wealth is actually lost. We have a famous saying, time in the market beats timing the market.
Because predicting short-term macroeconomic movements is functionally impossible.
Completely impossible.
But our brains don't care. We see a headline about inflation or geopolitical conflict, the market dips, and loss aversion kicks in. We feel the pain of losing money twice as intensely as the joy of making it. So we panic and we sell our index funds at the exact bottom of the market just to make the anxiety stop.
Right. And if we connect this to the bigger picture, Human emotion is fundamentally misaligned with successful investing.
How do you mean?
Well, our evolutionary instinct is to flee from danger, which in this case translates to a market crash, and run toward safety or reward, which translates to buying at the absolute peak of a market bubble.
So we naturally want to buy high and sell low.
Exactly. To survive this, we require a systemic mathematical workaround.
Which brings us to dollar cost averaging.
Yes.
The practice of consistently investing a fixed amount of capital on a set schedule, regardless of asset prices. Like you deploy $500 on the first of every month, period.
The brilliance of dollar cost averaging is how it completely short-circuits that loss aversion.
Okay, tell me more.
When you invest a fixed dollar amount, you automatically purchase fewer shares when the market is expensive, and crucially, you purchase far more shares when the market is crashing.
So when the market drops 20%, you aren't panicking because your $500 is suddenly scooping up shares at a massive discount.
Exactly.
You actually want the market to drop while you're in the accumulation phase.
Yes, it mathematically optimizes your average purchase price over time. It turns market volatility from a source of absolute terror into a structural advantage.
Right.
But, and there's a big, but here, dollar cost averaging only works if you actually execute it.
Right. And that is the friction point. We get busy, you have a huge project at work, the kids get sick, you're exhausted, and you just suffer from decision fatigue.
Oh, yeah.
You forget to log into your brokerage and deploy the capital, which is why the ultimate fail-safe is automation. You have to remove your own willpower from the equation entirely.
Pre-tax paycheck deductions for a 401k are the gold standard for this.
Because the money is gone before you even see it.
Exactly.
Yeah.
The capital is deployed before it ever hits your checking account. You cannot spend what you never saw. And for individual accounts, linking your bank to automatically fund an IRA or a taxable brokerage achieves the exact same result. The algorithms do the work while you sleep.
To set it, forget it, and let the machinery do the heavy lifting.
Yes.
But for the listener looking to optimize their specific setup right now, let's talk about the landscape of tools available to automate this. Because not all platforms serve the same purpose. Where should someone get advice? Like, when should they use a traditional brokerage versus a robo-advisor versus a human financial planner?
It really comes down to portfolio complexity and your desire for control.
Okay.
If you are comfortable selecting your own low-cost ETFs and setting up the recurring transfers, major brokerages like Charles Schwab or Fidelity provide excellent fee-free infrastructure and robust educational and screening tools.
But what if you know that even picking the ETF is going to cause you decision paralysis?
Then you utilize a robo-advisor like Betterment or Wealthfront.
How do those work?
These platforms use algorithms to build and automatically rebalance a diversified portfolio of index funds based on your specific risk tolerance. They also handle advanced optimizations like automatic tax loss harvesting.
That sounds great. What's the catch?
Well, they typically charge a very low management fee, around 0.25%. But honestly, that is often worth it for the sheer behavioral benefit of never having to touch the portfolio yourself.
Right, it keeps your hands off the buttons. And then I assume the human advisor comes in when your financial life stops being just about accumulating index funds.
Precisely. If you are navigating complex estate planning, holistic tax strategies across multiple businesses, or intricate inheritance issues, that's when a fiduciary fee-only human advisor is invaluable.
Makes sense.
You're paying for customized strategy and behavioral coaching, not for them to pick winning stocks.
So what does this all mean? We started by talking about building a house. And if we look at the structural integrity of what we've unpacked today, the blueprint is incredibly clear.
It really is.
First, you pour the concrete, you insulate your portfolio from sequence of returns risk with a cash moat, and you wipe out high-interest credit card debt so you aren't walking up a down escalator.
Right.
Then you calculate your timeline to understand your compound and runway, and you aggressively capture the free money of your employer match.
Crucial step.
You install a highly efficient engine by utilizing low-cost, broad index funds to eliminate fee drag. And finally, you protect the entire structure from your own psychological biases by utilizing dollar cost averaging and completely automating the execution. Taking an afternoon to permanently set this machinery up is what dramatically shifts the statistical odds of long-term wealth in your favor.
It is entirely about designing a system robust enough to survive your own worst impulses.
Yeah.
And honestly, this raises an important question for you listening. If the core lesson of optimizing your investments is that human emotion, decision fatigue, and simple forgetfulness are our biggest bottlenecks, which is exactly why automating and removing willpower is so effective. What other stressful areas of your life could you drastically improve simply by automating the decision-making
Oh, I
process?
love that.
If setting and forgetting solves your financial anxiety and guarantees mathematical execution, where else could you apply that exact same logic to regain your mental bandwidth?
That is a fascinating way to look at it, because if you can build a solid foundation that runs completely on its own, you aren't just getting your money back. You are getting your time, your focus, and your mental energy back too.
Exactly.
And you can finally start building that roof with total confidence. Thank you so much for joining us and taking this deep dive with us today. Take some time to mull over that question, stress test how your own financial foundation is looking right now, and we will catch you next time.